Joining us now is Stephen Isaacs, chairman of the investment committee at Alvine Capital Management. Stephen, thanks for coming on the program today. Let me ask, first of all, what your take is on equities, because after that rout a couple of weeks ago, it doesn't seem that we've seen any kind of solid recovery or retracement.
Well, I want to bring in an old character, an old friend of ours, Alan Greenspan. Made some comments earlier this week talking about a very tight labor market in the US. And I'm wondering whether this is a little bit of support for the independence of the Fed. I mean, we know that Jay Powell has taken some criticism from the administration about interest rate policy, and we know that the Fed has also carried on, not just in the minutes, but in the comments that were made last week, to kind of make it absolutely clear that they were not going to be deflected and they were seeing higher rates on the way. And I think that perhaps some of his former colleagues in the Fed sphere are actually going to say, yes, let's give the Fed some support, and we will see those higher rates. So that's what's driving markets. Rather roundabout story there, excuse me for that one. If we see another rate hike in December, which I think is now pretty clear, if we see a couple of rate hikes in the first quarter of 19, which I predict, and I think is also becoming fairly clear, the data is still pretty good out of the US. And crucially, what did Jay Powell say, or it wasn't Jay Powell, one of his colleagues say in the February sell-off? He said it was something like small potatoes. I think it was expression something like that. So the Fed is not going to be concerned about markets at these levels.
Okay, so back to the Fed push, you know, the strike price has moved perhaps versus where we thought it was previously. I liked your roundabout story. I liked your reference to Greenspan. And it takes me nicely on to the M Live question of the day, the Markets Live blog question of the day, which is actually around Libor, which is what is the impact essentially of the higher Libor rates going to be? What will surging Libor do to markets, or has the structure of markets changed so much that this doesn't matter very much? You can either answer that very specifically or more broadly. I'm interested in what higher rates do to the US economy, because I've seen concern around housing in the US, Stephen. I've seen Bank of America downgrading the US housing sector. Are these warning bells we should be listening more closely to?
Well, I think as markets overall, there are winners and losers, and you've pointed out obviously some losers, and the famous Tina trade, there is no alternative, and the assumption that you just had to buy yield or something like that, that's out the window. Let's be quite clear. You know, we are moving to a different interest rate world, not just in the US, and that does have profound implications for individual asset classes within the broader index. I think the US economy can live with this level of interest rates. I think there is some advantage of seeing a higher discount rate. I think you're getting more capital expenditure. It's helping bank margins, obviously. So I think overall, and we're seeing it in the markets, to be quite frank, you know, a mixed picture running through this quarter in the US market. It's a mixed picture, perhaps a little bit more volatility, perhaps a few more nasty down days to contend with going into the first quarter. And then we've got to ask ourselves, the absolute key issue is, when does the tightening cycle end?
Yeah.
And my view is probably second quarter of next year. We are not that far away now.
What,
Matt,
if we're in a different interest rate world, or are we in a different returns world, Stephen? I mean, what kind of, especially from equity investments, what kind of returns should an investor be able to expect?
Well, this is a problem. It's very difficult to make money. And I think that the sort of assumption that you can carry on just surfing this huge bull market indefinitely and that the last 10 years has been incredible and one should extrapolate those returns is obviously a very naive one. You know, markets are volatile. They go up and they go down. We've had an incredible run, and our advice to clients here is, you know, be very careful. It's very easy to lose money. But, you know, moving on to other markets, perhaps we'll talk about Italy. Anna, you ready for talking about that?
We will do. Later. We'll talk about Italy, but first I want to stick with the Fed theme, actually, Stephen, because this takes me nicely to this chart, which I thought was really interesting. This is a TIPS ETF, the biggest TIPS ETF, which has shrunk almost every day since September the 10th. And in a world where we're expecting higher rates from the Fed, why are we not more worried about inflation than this would suggest? Is the ETF wrong, or actually is the Fed hiking despite fairly mediocre inflation? Does Trump have a point? What are your thoughts?
Well, I think what the Fed are actually saying is we'll deal with inflation. You know, we're not frightened to actually tackle this problem head on. I think what markets or what inflationary expectations really don't like is the sense that the Fed has abandoned a desire to control inflation. So I think that answers your question. You know, there are bigger questions in Europe which perhaps we can talk about, and that really surrounds, you know, who's going to replace Mario Draghi? You know, he's got less than a year to go. Obviously, to some extent, the politics has been focusing only on Brexit. But for markets, the absolute key question that we ask ourselves going into next year is, who is going to be the next president of the ECB?